Hello everybody. This is the third video of class 7 and it's the introduction into the basics of capital budgeting. So let's go to a slideshow. So we'll make this full from the beginning. There we go. Okay. And this video should not be very long. It's just going to be the first 6 slides or so. And it's really just intended to get you all thinking about what our next chapter is. I actually can't believe it. We're really moving along very nicely. We've done a lot of nice work with financial accounting and cost accounting and uh, all kinds of variance analysis on budgets and uh, how to allocate overhead costs and then also to understand the fixed and variable costs and how to do variance analysis on those. I think we've done a nice job. And now we're coming into the last few chapters, and these are like more like subcomponents of the overall budget. But one of the important things is capital budgeting. And what is capital budgeting? It involves the acquisition of large projects or fixed pieces of equipment. Generally, land, buildings, and equipment are among the most important decisions made by healthcare managers to acquire these things because first they involve an awful lot of money, and secondly, they typically are costly to reverse and extend over long periods of time. Once you make a big commitment in a building or a big piece of equipment, you're committed to using that for a while. And finally, define the strategic direction of the business. If you have these assets and if you're doing it properly, you're thinking way ahead of time of what, um, well, you're thinking well in advance, you'll have the opportunity to plan the acquisition carefully and thus will be able to negotiate the highest quality of the assets at the best prices. And it's bringing your strategic plan forward. You're implementing your strategic plan. A lot of times, some of these projects take a whole year. Where I work, we've actually built another facility, a couple of other facilities, and we plan for that in a year or two in advance. One of them, we actually bought the land like 6 years in advance before we knew we would have the capability to finance the new project. We opened up a smaller office where we were generating business and interest, and we had a good core business going, but it was way too small to service the needs of the community. So we bought the land, had bought the land, and we were taking our time trying to figure out the best way to get the financing. Got some grant money because we are a nonprofit, and then we were able to build it out. And that build out took about 10, 11 months. And then we also have to consider after that build out the costs involved for startup. You've got to invest a lot of, you've got to buy also not just equipment, you've got to have staff there that are sort of like a sunk cost or a fixed cost as you're doing your startup as your business grows, and you have to make sure you have cash to do that too. So that's all just a little bit on capital budgeting, and it's best when you're capital budgeting um, when you're going through the budget process. And let's go to the next slide. Um, we just talked a lot about in our last chapter about budgeting itself and how to do the statistical budget and the revenue budget and the cost budget and bring that all together into one static budget and how you look forward for 5 years and all the detail in the first year that you build up by department. So you can go bottom up or top down or, all the things that we discussed. Um, this is one component of that master budget, and it has to do with capital projects. They can slide into your budget, and and you can see how the impact of this capital budget impacts your operational budget. But it's good to put um, a lot of times there's a lot of competing projects that you want to do, a lot of capital projects. And it's good to kind of categorize them in different groupings because it kind of prioritizes and it keeps everyone straight as far as, well, we can't do that this year, maybe we can do it next year. So let's talk about these general categories. And by the way, the book, I think, does a very good job on discussing the concepts of the project, of the capital budget, especially, and today, in this video, we're going to be doing pages 491 through 500, just a short introductory to get us going. So the categories, mandatory placements. Those are capital items where you absolutely know that you're going to have to replace them because they're worn out or damaged or just not working right. So those are generally, there's not a lot of analysis you're going to do because you have to replace them. Generally, when you're looking at mandatory replacements, you're looking to see if you have larger future capacity needs, and if you do, you might want to get a more efficient or a bigger unit. You also look at just certain trends going forward, making sure that you're going to be doing that for a while. Then there's discretionary replacements. This category includes expenditures needed to replace serviceable but obsolete equipment. The purpose of these projects generally is to lower your costs or provide more clinical effectiveness. So these are the kind of things where you've got things that are working, but you know that if the machinery you could do a better job, or you could rearrange your facility a different way, become more efficient. Third category is the expansion of existing services or markets. You want to expand your ER to different kinds of better services instead of having to ship some of your ER off to another facility. Or you want to add, you want to expand on a service that you have. Then the fourth category, expansion into new services or markets. This is where, like at our place, we've done this a few times. We've wanted to add pharmacy to our services. We've added dental. Then even within the dental, you might want to add a special line where you might want to concentrate on pediatric dental or oral surgery, or some other specialty within the service that you already do. Usually it comes about by something that you've already farm out, and you're wondering if you could do it better, have more control over it. That most of the time works, but you've got to get the expertise. Fifth category is environmental projects. This category consists of expenditures necessary to comply with governmental orders, labor agreements, or accreditations. Unless this is really a big requirement, it kind of fits into category 1 as sometimes being mandatory. If it's super big and super large, you just want to have it separated out because it will need a lot of consideration, where normally the mandatory replacements don't. And then there's always the last category, is just the catch-all projects that really don't fit nicely into any of these categories. And there's always something that comes up. Okay, so let's go on. Okay, the role of financial analysis. We're separating this out to two different kinds of organizations: investor-owned, privately held businesses, and non-for-profit businesses. There's a lot of arguments that there really isn't a heck of a lot of difference on how you should look at capital projects. There is some nuances that do make sense. Investor-owned businesses, financial analysis identifies those projects that are expected to contribute to shareholder wealth. It's profit maximization. You have a lot of competing projects. You shouldn't be concerned about, theoretically, let me take that back. You should be concerned, but theoretically you don't need to be concerned about the impact on the community. So it's just more of what will give you the largest return for your investment. And you can have several projects that are planned. One might be giving many more jobs in the community, but not be as profitable as one where you have a project that outsources your production, and under the investor-owned for-profit, you would really just be looking at maximization of wealth. The not-for-profit business, though, financially identifies projects' expected effect on the business financial condition. We have that same need in the for-profit, in the non-for-profit, to be able to pay your payroll and meet your financial requirements, but you can temper that with meeting the community needs and not necessarily just doing something that's outside of your mission. So you're much more mission driven. Okay, let's now look at some key concepts in cash flow. Okay, so in budgeting capital, cash flow is what it's all about. You want to make sure you understand what your initial cash flow outlay is. So what you're going to do is measure the impact financially of your project. And one way to do that is to do time value of money and understand your cash outflows, your operating flows, and then your terminal or ending flow at the way end of the project. Not just through implementation, but when the project, or you expect the project to be ending. You must also assess the project's risk. Some projects are more risky than others. Some may not work for a lot of reasons. And there's a financial tool that you can use to measure the impact of risk on your tool, and you'll get a range on projects. A lot of times, don't forget, you're trying to understand competing projects. You only have so many resources, so you have several projects that you'll be looking at, and you want to do analysis of which one may be part of your decision process to decide which one gives you a better financial return. Estimate the project cost of capital, opportunity cost of capital, or discount rate. And we'll get a little bit into more opportunity costs in a moment, and measuring some of the financial impacts. Remember that cash flow is different from accounting income. Accounting income, you might have depreciation, where there is no cash flow amount with that. We concentrate on incremental cash flow. That means both positive and negative cash flow because of the project. So what you do is you look at your normal cash flows and you see how this project impacts that by adding more cash or decreasing cash for short term. And your increased cash flow equals your cash flow with the project minus your cash flow without the project, just like I just said. Cash flow timing usually means flows occur daily, but we don't have the capability or the time or the need, or it's kind of overkill to try to do daily cash flow through a whole project. So you look at it more on annual cash flows. And projected life of a project is often unknown. And what you can do is, because of time value of money and the impact, you can just do an arbitrary end to a project. You don't know how long the building is going to last. It's 30 years. You might say, just arbitrarily say 15 years. And that's your time that you're looking at as far as cash flow is concerned. Okay. Now, some key things to look at when you're trying to figure out your cash flow do not include sunk costs. Okay. Sunk costs are costs that you've already incurred, like I mentioned earlier in my example, if we bought the land 6 years before we built on it. If we're now looking into or starting to figure out our whole capital project for our new facility, one of the things we would not include is the cost of the land that we purchased 6 years ago. And that's because the theory is this: we've already had that cost. We have an option of doing other things with that. We could sell it and get money. So it's already been accounted for a long time ago, and it's not in the future cash flows of the business going forward. You do include opportunity costs. And we'll talk a minute about some opportunity costs. Um, what we're referring to with opportunity costs is what could we be doing alternative uses with this money? And a lot of times you want to, when you're trying to evaluate the project, you want to consider that in your cash flow. Could I be doing something else different with it? Am I losing something by doing this? And that's both for capital and for other resources. Now you should be sure to consider impact on other business lines. Okay, say um, you're going to build out a new unit in your hospital, um, but it's going to make another part of your hospital obsolete. That is a business line. Well, you've got to consider that in your costs because you won't be getting revenue from that obsolete line, so it could negatively impact um, that business line. Now, that's not to say you should or should not do it. It's just that when you're looking at cash flows, it has to be considered. Inflation effects must be considered, but I would temper that with saying that generally, in the times that we are now, inflation is not a big factor, especially when you're looking at time value of money, where you're trying to bring it back into current dates, current ranges. If you've got a big inflation factor on some future cash inflows, you might want to consider having it as part of your time value, um, increasing your percent so that you're bringing it back to more equal dollars now. But also back to cash outflows. If you've got big cash payments, balloon payments at the end of certain things, with long-term capital investments, you might want to also look at how you're going to get that inflation factor to have actually more power of the cash and be more cash you'll be needing. Strategic value is a very important consideration on your cash flow. So you really want to know what value to your strategic plan going forward. And what I mean by what everyone means about strategic value, you may want to invest in a line of business or a new market because you need to get into that market. Now, you might be going in and not having to start a very successful um, financial results, but you know it's a whole new line. An example of that is I think we've all heard that like Health New England is going into the Medicaid market and offering a mass health product. That was a decision they made, and they think, maybe short term they might not do well, but they think it's a market that has very big potential, and they want to get into it, so they're going to invest in that. It's almost like an investment. It is an investment, and they're going to have future returns that you want to try to measure as a strategic value in the future. Well, believe it or not, that is all I really wanted to say about capital budgeting to start. We're going to be doing a lot more on cash flow analysis, and we'll probably talk about this some more at our class. Please read that chapter 14. This is chapter 14. It's a very good chapter, and I think be real important for us to understand capital investments, especially since most of you, that will maybe your first introductory into doing some budgeting. You'll be involved in a new project, and you'll be asked for some input, and now you'll be understanding what they're looking for and the terms they're talking about. So I'll talk to you soon, and have a good evening.